DSCR loan rates and conventional mortgage rates both jumped 13 basis points this week, with the 30-year fix climbing from 6.32% all the way to 6.45%. 3 consecutive weeks of declining rates just got wiped out in one swing. The culprit? A war-driven oil spike, a stubborn Fed, and inflation data that refused to cooperate. Stay until the end. I am going to show you exactly how avoiding riskier property types can lower your DSCR loan rates by half to 1%, even while the market is moving against you.
The Fed draws a line. Why Powell's final meeting made things worse.
On April 29, the Federal Reserve held its benchmark rate steady at 3.5 to 3.75%, and the language they used was anything but neutral. The committee explicitly acknowledged that inflation remains elevated, partly reflecting recent increases in global energy prices, which is Fed speak for. Don't expect cuts anytime soon. This was also Chairman Jerome Powell's final meeting before Kevin Warsh takes the chair, and it features the highest level of dissent among FOMC members since 1992, a signal that even inside the Fed, there is no consensus on where rates go from here. Markets had been hoping for at least a dovish hint heading into the summer. They got the opposite. Officials now project just one rate cut in all 2026, with another in 2027, pushing the funds rate slowly toward a neutral level of 3.1%, a timeline that keeps pressure on mortgage rates for months to come.
The inflation 1-2 punch. PCE and oil hit at the same time.
The March PCE report landed on April 30 and confirmed what the bond market had already started pricing in. Core inflation accelerated to 3.2% annually, its highest reading since November 2023. Headlines: PCE surged 3.5% year over year, driven in large part by oil prices that crossed 102 per barrel after escalating US-Iran tensions. That is a 43% increase in oil prices, and when energy costs run hot, they bleed into transportation, manufacturing, and services. The entire inflation pipeline. Treasury investors responded by demanding higher yields to protect their real returns, pushing the 10-year Treasury yield to 4.42% by April 29. Mortgage rates track Treasury yields closely, and 13 basis point spike this week was a direct consequence of that repricing. This wasn't a market overreaction. It was the bond market doing exactly what it is supposed to do when inflation data and geopolitical risks show up at the same time.
The rate update. The major economic indicators and how they're affecting your wallet.
30-year fixed mortgage rate started at 6.32%, ended at 6.45%, a net increase of 13 basis points for the week. DSCR loan rates, which carry a 0.75% premium above conventional mortgage rates, moved right alongside, landing in the high sevens, range for most rental property investors this week. If you were sitting on the deal hoping for a sub 7% window to reopen, this week moved that conversation further away, not closer. Q1 GDP, the economy grew 2% annualized. In Q1 2026, a rebound from Q4's weak 0.5%, but below the 2.2% forecast. Consumer spending slowed to just 1.6% growth as inflation eroded purchasing power. Solid enough to keep the Fed from pivoting, not strong enough to change the rate trajectory. Consumer confidence. The conference board's April reading edged up to 92.8%, the highest of 2026. The labor market differential widened, meaning more people think jobs are plentiful than hard to find. Resilient consumers combined with accelerating inflation is the exact environment where the Fed has zero incentive to cut.
Your move. Lock now or wait for a pullback that may not come.
Here is the honest read this week. Rates reversed hard this week because of forces that don't resolve quickly. Geopolitical tension in the Middle East, a Fed that just told you it is not cutting, and inflation that is moving in the wrong direction. The jobs report drops May 8th, and if payrolls come in strong, you could see another leg up in rates before any relief materializes. Floating in this environment isn't a strategy, it's a gamble. If you are actively under contract or about to be, the math right now favors locking. A future pullback is possible, but it requires oil prices to fall, inflation to cool, and the Fed to signal a shift. That is 3 things that all need to go right. Waiting on all 3 simultaneously is how investors end up with a deal that no longer pencils. Now let me unpack the strategy I promised you. Avoid riskier property types. Single family homes consistently price better in DSCR programs than condos. 2 to 4 units. Properties multifamily of 5 units or more. Mixed use properties or anything the lender classify as non-standard. When you are already dealing with elevated DSCR loan rates like we have right now, the property type you choose can be the difference between a rate that is 0.5% to 0.75% lower before you have negotiated a single thing. That is not a small number over a 30-year hold. If you want to explore other strategies that work better for your specific situation, call or text me directly. Our info is in the description below, and I will walk you through exactly how to position your next deal for the best possible pricing.
If you want to learn how to use financing to grow your portfolio, check out my DSCR Loan Tips and Tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.